All right. Hello and welcome. My name is Dr. Mallory Chavan, and I'm a pediatric gastroenterologist working in Los Angeles. And as you all know, if you are in the medical field and gone through medical school and residency, we focus a lot on about our studies and treating patients, but not enough on our financial life and financial planning. So I have the pleasure of being on this call with Mr. Bob Hall and David Cook. Mr. Bob Hall is a mortgage specialist I've worked with and got a lot of insight from in terms of mortgage planning. And Mr. David Cook is an expert in relocation. He's gone through a lot of relocation through my medical career because, full disclosure, Mr. Cook is my husband. So I thought it would be two great people to talk to today about the specific subject. So how about we start with you, Bob? Can you talk a little bit about what loans are available, or if any, for physicians and residents?
Sure. Thanks, Dr. Chauvin and David, for allowing me to join you on this call. So, as you know, from when you did your mortgage, doctors have some challenges when it comes to maybe not saving up for a down payment yet when they go through all their training. So they come out of a stage where they are not making as much money as they do when they go to attending. So what we do is we focus on a zero down payment option. So doctors can put as little down payment as possible, meaning nothing, and they would have options to do 5% down, 10% down, or whatever. They're not limited to 100%, but a lot of doctors do that coming out of training. And so the benefit is a little bit of keeping more money in your pocket, not having to save up for a down payment, and having zero mortgage insurance, which I'm happy to go into that later. But most doctors are going to find out when they start searching is you will have to make a down payment with most lenders. You don't have to do that with a doctor loan and with what we do here at Truist. And I've been here about 20 years, by the way.
That's awesome. And is that something, using this kind of loan, something that could make me less competitive with other buyers? David, what have you seen about putting offers with clients who have doctor's loans? Is that something that could play against us?
You know what, to be honest, recently, the experiences that I've had with physician loans, they've actually worked very well because, when you're buying a house, a lot of people think, oh, cash is everything. And in actuality, it's not. It is definitely, beneficial if somebody's paying all cash, but people understand that the way the market is right now, sometimes it serves you better to keep that money in other vehicles. So instead of, putting all your money into purchasing your house, you're keeping liquid as much as possible. So basically, you can invest elsewhere and you're actually putting less skin in the game up front, which is nice. So you actually have, that infinity loop as you're growing the value of your home and all that. So basically what's happening is the value of your home is going up. And instead of making, say, $200,000 or $300,000 over the course of a few years on, $200,000 or $300,000 that you put in, you're making $200,000 or $300,000 on $0 that you put in. So it's definitely competitive, and a lot of sellers actually see that, and they also look at physicians as, these people are going to close, and they feel safe dealing with physicians because they know that they're going to meet the targets that they need to.
And obviously, as we go through medical careers, there's a lot of debts because school is expensive, and there's quite a period of time where we're not paid for our work. So I think that's a builds into the hesitation to buy a home or apply for a mortgage. Bob, can you talk a little bit about that? If we have large, already student loans, how that can affect our experience in applying for a mortgage, or should we be deterred from doing that?
Right. Well, yeah. And first of all, I'm just going to agree with David on that because just as to backtrack for a second, I had a client that I worked with. A lot of times I work with someone in residency, and then when they go buy a different home or they're attending and then buy a different home and move, they're not in their home forever usually. So one guy said, hey, I put down no money before, but my house is I know, we're in a rate environment that's a little bit different than when I bought before, but my house has appreciated to where I bought the home for $250. It's worth $500 now. I'm not saying everybody's going to have that $250 increase in their value and double the value, but it happens a lot. So that is a very true statement he was just talking about, with putting no money down and then all of a sudden not being in a situation to where, oh, I don't have any equity. You may through appreciation in the market. Now back to the debts you're talking about. That is a big benefit. With a standard mortgage, you may want to call it a Fannie Mae loan, an agency loan, a typical government loan, or any loan that any lender can provide. When doctors or other students come out of residency or come out of just school and they have a lot of student debt, if you get a typical mortgage, what you have to look at is how does that impact buying a home? So in loan lenders look at your total income and then look at your total debt. They compare that, and that is what makes up your debt to income ratio. With a student loan, if you're doing a typical Fannie Mae conventional loan that anybody can do, it's either going to be counted as 0.5% of the balance or 1% of the balance, depending on what kind of underwriting system you run it through. So no matter what, you have a $200,000 loan. If you run it through underwriting one way, you're talking about, wow, 0.5% of that is my monthly payment, or even 1%. So do you need a $1,000 or a $2,000 payment can be a huge monthly payment. With the doctor loan, we have ways that if you're in training to count either zero payment, regardless of the balance, it may be 300,000, it may be 400,000. You can count zero the balance, or you can do what is called the income-driven repayment. And we send out to all clients or potential clients a website that you can look in, and you plug in your household income, and we give you all the instructions on how to do it, that we can use that payment. Or if you're already making a payment, we look at what that payment is. So there's definitely different options. That the doctor loan is more flexible on counting your student loan income, and that could help you with your buying potential and being able to qualify.
That's great. And is there a specific credit score that we need to qualify for these loans, or where should we be at to be a good candidate?
So with the credit score, one thing you definitely want to do is, I would recommend, doesn't cost you anything, not just looking on Credit Karma or your bank app that tells you credit score. Have a lender pull your credit, whether it's me or a different lender. Mortgage lenders dig a little bit deeper. So you want to find out what your true credit scores are that the banks are going to look at. And that credit score is basically good for 120 days, meaning we don't have to pull credit again if you close on a home before 120 days. And so when we do that, we'll tell you, hey, here's your highest credit score, your middle credit score, and then your lowest credit score. We throw out the highest, throw out the lowest. We take that middle credit score. The middle credit score, if you want to do 100% financing, has to be a 720. Okay. If you are going to make a down payment of, let's say, 10% or 10.01 or 15 or 20, you just need to have a 680. So you can do something different, a 5% down payment with the 700. There's different things we can also do to help you with looking at why is your credit score maybe not a 720, and then what you might need to do to help to improve that to get it up there if you do need to do 100% financing.
Mm-hmm. And is there a certain amount of time we should wait, or have a planning period? And should we wait out after our residency, or to start doing those kind of planning and assessment of our credit?
I would think if you're in your final year of training, there's going to be some people that are just finishing their last few months of training right now. They're winding down their last year of residency, whether it's a 3-year or a 4-year program, whatever their program is, whatever their specialty is. It doesn't hurt to start looking now, because they might be starting a job in, let's say, August. We can help them close before their start date, up to 90 days before they start that new job, which you're not going to be able to do on some loans. So if the credit report's good for 120 days and you can close 90 days before your start date, now is not a bad time to start looking. You're not committed to the lender by having them pull your credit. It just kind of puts you in a better spot to be able to figure out. Plus, I've had times where, unfortunately, someone didn't know that they had not closed a credit card and they had something open, and that dropped their score when they had been paying everything else on time. So it allows you to know what kind of things you should work on if you need to.
Oh, that's
Also,
awesome.
one other thing about that, is we can take alternative credit. So if somebody doesn't have established credit, maybe they only have one credit card, a lot of lenders will look at that and say, hey, that is thin credit. You might have paid that thing on time, that one credit card or a car loan. But if you don't have 3 active open trade lines, meaning credit cards or a car loan, then you have what's considered thin credit. We can help clients qualify for a mortgage, even if they're not making a down payment, with alternative credit. So they can do things like, hey, why don't you get 12 months of your bank statement or Venmo payments to your utility bill or your cable bill? And that can be used as a different form of credit.
Hmm. Very interesting. Thank you. And as you were talking about new jobs, where just the match was just a couple weeks ago, and residents are looking at their new positions. David, can you talk a little bit about relocation and what that looks like for people? How can they find their home?
Yeah, absolutely. So as somebody, as you can attest to, we've been through this many times, finding a place before moving to a new city. So like, uh, you know, typically, you'll find them online or whatever. But it's nice to have boots on the ground, and that's kind of where I come in. So, say you're moving to a city that you've maybe been to for, you know, a couple hours for an interview or something like that, but you really don't have any experience in the city. You don't know which areas to purchase in or where you don't want to be, or, traffic flows or things like that, which especially in Los Angeles, you can be 10 miles away and it can be a 45-minute drive. So it's important to kind of know the areas. So what I'll do is I'll kind of sit down with you on a Zoom or FaceTime or whatnot, and just kind of go over what's important to you as far as what you want to be near. If you want to be near restaurants, cafes, shopping, whatever. You want to be close to the hospital because you might get called in late at night or whatever it may be. I'll help you find somewhere, an area that you want to be in, but also I'll actually go and preview the properties and everything for you as well. And I've got lots of clients that I've been dealing with out of state and all that, and I'll go and I'll do a video tour with them, and if they're able to be on it, great, we can FaceTime. And if not, then what I'll do is I'll record video and I'll send it to them afterwards. And then we'll sit down and review that together. And it's been great. And I feel like most people, you can get a pretty good sense of the area when you're, first off, hiring an expert to kind of help you through the process, but also, you're seeing it for yourself. And when I'm showing you those properties, I'm not just showing you the inside and the outside of the building or the house or whatnot. I'm showing you the area too. So I'm going to send you detailed information on what the area actually has, that would kind of check the boxes that you're looking to check.
Awesome. And the